Welcome to part 3 in the series on risks in retirement. Today I want to go over investment risks that can have an impact on retirement income planning, specifically market risk, interest rate risk, and liquidity risk. All of these risks, as well as the others I discuss in this series, deserve a much deeper dive than I'm offering right now. You really should have your financial professional look at the whole picture with you when planning. But for now I'll do a shallow dive, so let's jump in. Market risk, the risk of loss due to negative movements in the market. This risk is most impactful in the years leading up to and just starting into retirement. Let's say you started your retirement right before the start of the Great Recession of 08-09. You'd have to sell a lot more shares of funds to get you the same amount as if you retired a year or two later. The difference in drag on your wealth can be huge. Many clients also interpret market risk as having too much in equities or stocks. Now, this point can be counterintuitive since too little in equities can bring your performance so low as to create not enough to live on. So how do you reduce this risk? Well, purchasing an annuity with guaranteed income is one way. Taking less in down markets and then more in up markets to offset the smaller amount you took in down markets is another. Building a conservative pool to draw from in these early years is a third way to do this. Now, many of these strategies are used in a flooring approach, where you make sure that basic expenses are met with as little risk as possible to avoid surprises, using the more aggressive portions of your portfolio for enhanced lifestyle, travel, gifting, etc. Next is interest rate risk. This could mean a couple of things. If you have bond funds in your plan and interest rates go up, your fund values could go down. This isn't the same as holding an individual bond to maturity, where you can pretty much predict the income it'll produce. Interest rate risk can also mean that returns on fixed income or bond type investments may not be enough to meet performance needs. It's kind of where we are now, where we're continuously looking for ways to create income without too much risk outside of the bond market. The trade-off to some of these solutions, and there are some, leads into the next and last risk for this video. Liquidity risk. In simple terms, it's having the money available when you need it, being able to sell at a reasonable value quickly. I mentioned annuities, which can guarantee income and remove a great amount of risk, but there's not a solution for all of your funds. Real estate investments and different types of CDs are other examples. But you need a balance of security and liquidity. Another interesting way of looking at liquidity risk means having too much liquidity. If it's all liquid and too easy to get at, that can be dangerous to clients with low self-control. It can also be a tempting target for those who prey on seniors. I discussed financial elder abuse in a prior video. So let's come up for air. Well, I hope it got you thinking enough to get you to plan. In the fourth session, I'll review a number of the less obvious but still significant risks to plan for in or around retirement. Thanks for watching.